Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. China's stocks surge as investors bet on more stimulus from Beijing. In the US, futures bounce back as the risk of a government shutdown fades. That's a day after the benchmark S&P 500 slid into a correction. Putin pushes back. Russia's president warning any truce should lead to a long-term resolution of the war, saying there are issues he wants to discuss with the United States. Plus, the ECB president warns of the severe consequences of a trade war for the global economy as President Trump threatens 200% tariffs on EU alcohol imports. Happy Friday. So after flatlining yesterday, European stocks pointing higher in the futures by 0.5%. The relief around the standoff on the shutdown in the US, that risk seems to be easing. Chuck Schumer has essentially folded. US futures are pointing to a brighter session. But the context, of course, is that the S&P is now at a 6-month low. You saw losses again yesterday of 1.4% on the S&P 500, 1.9% on the Nasdaq 100. You are down 10% now since the highs of December for the S&P 500 in correction territory, as is the Nasdaq. And year to date, the S&P 500 down 6%. Compare that to European stocks, despite the losses of this week, still up 6% year to date. FTSE 100 futures here in the UK looking to add 0.3%. S&P futures, as I said, pointing higher, up 0.6 after the losses of yesterday. Nasdaq 100 futures looking to add 161 points. Let's flip the board and have a look cross asset. You saw yields lower by 4 basis points on the benchmark 10-year in that Haven move yesterday as equities sold off. A similar picture in terms of the Haven story for gold as well. 428 right now on the US 10-year with yields up close to 2 basis points. 108 on the single currency. We're listening in, of course. We've been hearing from the ECB president speaking to the BBC about the potential impacts on global trade as a result of Trump's tariff war. $70 a barrel on Brent, up 0.7%. And gold, that Haven bid, pushing it to fresh record highs, closing in to $3,000 just down 0.1% so far in the session. It's a big day, though, over in Asia. Expectations building of more stimulus coming through from Beijing. Chinese shares hitting their highest level this year on expectations of more policy support for consumers, and that is crucial. Consumers. Let's bring in our executive editor for the Asian markets, Paul Dobson, who joins us from Singapore. Paul, a big day for Asian equities, a big day for Chinese stocks. What's behind the rally then?
Yeah, hi, good morning, Tom. So a lot of excitement over this press conference that's going to be held on Monday across a bunch of different Chinese departments talking about ways to stimulate the consumer. Remember, this is hugely important for China. It's the kind of missing piece of the puzzle, getting consumer confidence back, getting people spending again, particularly in the context of this looming tariff war with the US and the possibility that it's not going to be able to rely so much on exports in order to stimulate the economy. So instead, it wants to have more demand internally in order to kind of like keep the money circulating and stuff like that. So everybody very excited and focused now on what that meeting might deliver. It was promised to us already over the MPC. The flip side, of course, is that these meetings have disappointed us in the past. So people looking for the authorities to deliver this time.
Yeah, Paul, as you say, there is that history of disappointment, isn't it, when it comes to these meetings, as they gather these policy heads and lawmakers to hold these press conferences. What specifically, then, do you think markets are going to be watching for in terms of metrics, in terms of the language of officials out of Beijing on Monday?
Yeah, I think you're right that tone matters as well as content, right? The most impressive press conference that we saw last year was when the PBOC really came out and gave, kind of like a little bit of a firework display where they talked up with a bit of, kind of showiness what they were planning to do. So I think the market will hope that there's that kind of an approach from policymakers. I think it will hope for a big $1 billion or billion yuan figure to attach to it. More specifically, so there was an announcement that there's going to be some efforts to get banks to lend more to the consumers. So that's quite interesting and new. We're expecting that there will be childcare efforts, in order to get people out to work and to keep on spending going back into the economy that way. And then a couple of the programs that we've seen that have already been successful, the trade-in program, where it's a bit like the US cash for clunkers, where people exchange older goods and get given a voucher or a token for that in order to put towards buying something newer instead. And then on top of that, more voucher support broadly, getting people going out, getting people, kind of moving to the shopping centres and spending on consumption in general as well. So those are some things we're looking out for. But a positive surprise would be something on top of that. A negative probably outcome would be if we get some of that and not all that much exciting stuff new or not that big a number behind it.
OK, and for now, at least, it does nothing, this story, to detract from the momentum into Chinese and Hong Kong stocks as money looks to flow out of US markets. Paul Dobson, our executive editor for Asian markets, thank you. On what to watch for, the market reaction today and what should we watch for in that meeting out of Beijing on Monday with the focus and lens on the all-important Chinese consumer. Now, US Senate Democratic leader switching focus to US politics right now and the risks there. Chuck Schumer is dropping his threat to block a Republican spending bill. The move opens the way to avoid a US government shutdown on Saturday. The two parties have been engaged in a standoff over the Democrats' insistence that a spending package includes some restraints on Elon Musk's federal cost-cutting crusade. Let's bring in Bloomberg's Valerie Tailtel for the market reaction. Val, we get to this point. It's like Groundhog Day in the US when it comes to the standoff over debt, the debt ceiling, spending packages, potential shutdowns of the government. Is there some way and some point where the US markets just are immune to these risks? I mean, it's risk off yesterday on the back of this. Now it's risk on. Is this a rational response? Talk us through the market reaction to the politics, domestic politics of the US.
Look, I think the equity market is just quite happy. We don't have to take this risk of a government shutdown into the weekend. We've woken up on the right side of the bed when it comes to risk on for U.S. futures. S&P futures up 0.6%. NASDAQ futures up 0.8%, erasing nearly half of the losses of yesterday. We're also seeing yields rise on this risk on move. But perhaps this risk on move, this move into the green, kind of overshadows just how bad a week it has been for the equity market in the U.S. If we take a look at how the S&P futures have performed since Monday, down over 3% in the last 5 sessions. Tom, you add this to the fact that last week, we already had a 3% drawdown in the S&P 500. Two back-to-back 3% falls in the S&P 500 week on week is something we've not seen in 3 years' time.
OK, and part of that is down to the tariff risk, of course. Val's going to stay with us. We're going to get more market reaction in a second. But we want to update you on what's been happening on the tariff story. It continues, of course, day in and day out. More adjustments, more changes, more commentary. The European Union's foreign policy chief has underlined the bloc's readiness to retaliate on US tariffs, while at the same time calling for restraint. Speaking to us on the sidelines of the G7 foreign ministers meeting in Canada, Kallas said neither side would benefit from the escalating tensions.
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from, U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests.
This comes after President Trump threatened a 200% tariff on all wines, champagnes and alcoholic products from the EU if the bloc goes through with a retaliatory 50% levy on American whiskey. US Commerce Secretary Howard Lutnick took aim at the European Union.
The president was totally annoyed that the Europeans did this, and so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley-Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Val, what is the current market understanding of these tariff threats? Is there an understanding now that this is a Trump administration more intent on rewiring global trade in the long term than in short-term leverage?
Look, Tom, at least for the equity market, it's all about whether this correction in the S&P 500 will be hand in hand with a recession that really opens up the door to a possibility of a bear market. I did some analysis on the history of corrections since World War II. We've had around 50 of them, and nearly 25% of those corrections have turned into a bear market, most of those accompanied by an economic slowdown. So if this tariff war, this wider global trade war turns into an economic economic slowdown, there could be more downside for the S&P ahead. Now, one thing, the other thing that the market is watching is also a widening of credit spreads. That's another hint that an economic slowdown could be on the cards. And on that, guys, Tom, in my next chart, just take a look. We have seen credit spreads widen this week. It's been one of the worst months since credits for corporate bonds that we've seen in nearly 2 years. But I guess the other side of the argument is we're just widening from extremely tight levels as this really rapid discussion from the U.S. economy going above trend to now slowing down into an economic recession has really taken the market by surprise. And on that, guys, you know, the S&P 500 entered a correction yesterday, and it's one of the quickest peak to troughs that we've seen in the S&P 500. It only took 20 trading sessions for us to get there.
OK, Bloomberg's retaliatory. Yes, those yields starting to blow out a little. Well, maybe not blow out, but widen a little, as you say, within the context. We're going to be speaking to the global head of credit at BNP Paribas later in the show, and we'll continue that conversation. Retaliatory with a market reaction. Thank you. Now, President Putin says he supports the idea of the US brokered Ukraine truce deal, but wants to discuss the details with President Trump.
So the idea itself is correct, and we certainly support it, but there are issues that we need to discuss, and I think that we need to discuss it with our American colleagues and partners. Maybe call President Trump and discuss it together. Overall, we support the idea to end the conflict by peaceful means.
While Trump remains optimistic about the possibility of a ceasefire, Ukraine's President Volodymyr Zelensky criticised Putin's response in his nightly address to the nation.
Putin is essentially preparing to reject it at this moment. Of course, Putin is afraid to tell President Trump directly that he wants to continue this war, that he wants to kill Ukrainians. Putin often acts this way. He doesn't say no outright, but ensures that everything drags on, that normal solutions become impossible.
OK, let's bring in Bloomberg editor Greg Sullivan right now for the details. Someone, of course, who's been following all of this very closely indeed. Through your lens, Greg, of experience, what guarantees do you think are we expecting that Putin wants to get and wants to squeeze out before agreeing to any ceasefire?
Well, we understand a few things here. One is that we think that Putin is making a play for time. He may eventually agree to a ceasefire, but he wants to make sure that it is on his conditions, with his guarantees, on his time frame. One such guarantee that he has floated has been a demand that Ukraine not receive arms or military aid during the period of any temporary truce. He's also made some more long-term demands that he has not backed away from. Those include no NATO peacekeepers on Ukrainian soil to act as any kind of peacekeeping force during a ceasefire or eventual long-term settlement. He also has not backed away from not wanting to see Ukraine join NATO or the limits on the size of Ukraine's military. These are tough demands, and so far we've seen no signs that Putin is willing to make any kind of concession. And most of the pressure from the White House so far has been one-sided against Ukraine and not Russia.
Yeah, indeed. It seems challenging at this point to see how the gap is closed. Is Ukraine? Is there any willingness? We saw that commentary from President Zelensky coming out strong in terms of the reaction to what he heard from Putin. But beyond that, behind the scenes, any sign that Ukraine is willing to relax on some of its own conditions?
Well, on the one hand, these are very tough conditions for Ukraine. Ukraine is probably not wanting to accept these. Russia was the aggressor, invaded Ukraine. They want the ability to defend themselves from future Russian aggression or future resumption of hostilities. They have said very clearly, President Zelensky and other Ukrainian officials have talked a lot about security guarantees, ways to make sure that they can deter future hostilities. And here we have Putin making demands that essentially robs them of that ability. Putin is essentially aiming to make sure that Ukraine cannot continue to fight after the resumption of any kind of truce. We know Western officials have assessed that Putin is making maximalist demands. He believes he can continue the fight. These are demands that Ukraine is probably not going to accept. But Zelensky's in a tough place. Again, the White House has been heaping pressure on him. We have not seen the same amount of pressure on the Russian side. He has to keep the White House engaged and remain at the table. So it is a very tough situation for the Ukrainian side.
Yeah, and as you suggest, it's also something of a test, isn't it, of President Trump and whether or not he's going to exert the kind of pressure he's exerted on Ukraine onto Russia now. Greg Sullivan, thank you very much indeed with the details. Coming up, To the tariff story and the threat around 200% tariffs on European wine and alcohol. Counter to counter tariffs. US President Trump threatening to impose 200% tariffs on European wine and champagne. He says it's going to help US champagne industry. Doesn't have one, of course. We're going to get reaction from the CEEV, which represents the continent's wine producers. What could the impact be on European wine and the industry? That's up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday, everyone. ECB President Christine Lagarde is warning that an escalation of trade disputes may have a detrimental effect on the world economy. Speaking to the BBC in a taped interview, Lagarde expressed concern over President Trump's decisions, saying, quote, if we were to go to a real trade war, that would have severe consequences. Adding, quote, for growth around the world and for prices around the world, but particularly in the United States. For more, let's bring in Ignacio Sanchez Recarte, the Secretary General of the CEEV, which is the Comité Européen des Entreprises Vin, which represents European wine companies, with the threat, of course, from President Trump yesterday to impose 200% tariffs, yes, 200% on European wine and other drinks in retaliation to the EU's retaliatory tariffs. Ignacio, thank you for joining us. What would the impact on your industry be of 200% tariffs?
Thank you very much. The impact is very clear. Is from one day to the other, we will have to stop to send our wines to the United States. There is no way we can sell wines in the United States. We can reach this market if we have if we are suffering a 200% tariff.
You represent 7,000 companies, wine producers and other producers within the wine and alcohol space in Europe. What would it mean for jobs? What would it mean for the industry? Would the industry be able to reship some of these products to other trading partners?
No, there is no way we can reship to other trading partners. So the United States is the biggest wine market for European wines. So 27% of our exports reach the US market. And the wines we send to the US are normally higher price, because the US, together maybe with the UK and a bit with Switzerland, are the best markets for wines. They really appreciate quality wines. So we are talking about almost 5 billion euros that from one day to the other will not have a market. And there is no way we can resend these wines to other. We can have an alternative market. So in jobs, it's difficult to count, because the problem of the wine sector is you cannot stop production. You have your vine, you have your grapes, you have to continue the harvest, but there is no place to put your wine. In the cellar, firstly, and then after, you don't have a market. So it will be a hard hit to the European wine sector and to hundreds of thousands of companies and winemakers.
Are we talking about companies closing down potentially as a result of this? Are we potentially looking at bailouts for some parts of this industry? I mean, how deeply damaging would it ultimately be?
Well, the damage is difficult to calculate, but I will assure that many grape growers, and we have around 2.3 million grape growers in the European Union, those people will not have companies to sell the grapes, because the companies will not have a market to sell the wines. So yes, definitively there will be a lot of companies who are now, the wine sector is suffering a crisis. There is a decline of wine consumption globally. So this will be the extra layer in the crisis, and definitively we will see companies closing the door, because there is no way that we can send to find an alternative market. So critical damage, and putting in serious situation the long-term sustainability of our companies.
Is it time, longer term, for your industry to deprioritize the US market?
Yes, obviously, we like to deprioritize. We love to have several other markets around the world that can absorb, but it takes years. I mean, it took us 30, 40 years to invest in the US market and to develop it. It has taken us 20 years to invest in China. the relation we have with the UK is centuries-based relation. So yes, ideally and theoretically, we would like to do it. In practice, in the short term, I'm talking about 5, 7, 10 years. That's the short term in the wine sector. There is no way we can revert all of these wine flows to other markets. But yes, definitely we will have to look to other places, and Mercosur, it's an opportunity open to us. But it will take years also to develop the wine market in Mercosur.
OK, so it's a much longer-term proposition. Ignacio, what is your message? You're sitting in Brussels. What is your message to the European Commission? Because the Trump administration would say this threatened 200% tariff is a measure to be imposed to retaliate to Europe's own retaliatory tariffs targeting US whiskey. Was that the wrong decision from the European Commission?
I think the wrong decision for the European Commission and also for the US administration, obviously, is to take wine and other agri-food products and spirit drinks within an unrelated trade dispute. I mean, why the agri-sector, why wine, why bourbon needs to pay for a trade dispute in the steel and aluminium? I mean, we want our sector to be exempted aside of these unrelated trade disputes. So yes, our call to the European Commission has been from years now. When the first war on steel and aluminium started, the first dispute was leave wine outside. And we were, at the time, we were successful in convincing the Commission not to hit the US wine, because we have nothing against the US wine. We are not protectionists. We have a super good relations with them. And together with the Wine Institute, so my counterpart in the US, we are asking for no retaliation on our products.
Ignacio, is there a silver lining for consumers in terms of a surplus of wine on the European markets and lower prices for European consumers?
The risk, obviously, there will be a risk that the price go down because companies need to empty the cellars to when the new harvest will arrive. But the prices of wine that we normally send to the US will not flow the EU market at a low price. So there will be a lot of tension. We will see a reduction of the prices. We'll see companies trying just to empty part of the cellar. But the volumes that we are sending to the US will not flood the EU market in any case. And prices of the wine is relatively cheap already.
Ignacio Sanchez, Recarte, Secretary General of the CEEV, which is a body representing about 7,000 wine producers across the European Union. Thank you for your time this morning. Coming up, the US Commerce Secretary, staying on the subject, takes aim, of course, at Europe. You can see more from Bloomberg's interview with Howard Lutnick a little later in the show. That's coming up. This is Bloomberg. Welcome back. Let's give you an update on the earnings coming through from Hon Hai, also known as Foxconn, the major producer, of course, of Apple iPhones, but also of servers for NVIDIA, the AI chip maker, of course. It is a miss in the fourth quarter when it comes to net income for Hon Hai at 46.3 billion Taiwanese dollars. The estimates had been for 54.4 billion. So a sizable miss in the fourth quarter in net income for Hon Hai. Part of this down to a slowdown in sales of Apple iPhones, but also heavy spend as well to build out capacity to provide those servers for companies like NVIDIA. Full-year operating profit coming slightly above the estimates. That's the full-year line. Net income, though, a sizable miss for Hon Hai. There's plenty more coming up. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. China's stock surge as investors bet on more stimulus from Beijing. In the US, futures bounce back as the risk of a government shutdown fades a day after the benchmark S&P 500 slid into a correction. Putin pushes back. Russia's president warns any truce should lead to a long-term resolution of the war, saying there are issues he wants to discuss with the United States. Plus, the ECB president warns of the severe consequences of a trade war for the global economy as President Trump threatens 200% tariffs on EU alcohol imports. Let's check in on the markets then with a slightly brighter picture, the stimulus aspect and prospects coming through from China. We'll wait to see what the details are on Monday with an important press conference and the focus on the Chinese consumer. But the rally in Chinese stocks continues and is given a further lift today. European futures slightly brighter after essentially a flat day yesterday, currently up 0.3%. The FTSE 100 futures here in the UK looking to add 17 points. S&P futures looking to gain 0.5%, but as we've been discussing in the context of a correction now, down 10% since December at a 6-month low on tariff concerns, recession risks and angst about the Trump policy agenda. Nasdaq 100 futures also in correction territory, but looking to add 145 points in the session today. Let's flip the board and have a look cross-asset. You saw yields down on the benchmark 10-year by about 4 basis points yesterday. Today, yields up just 2 basis points, preparing some of that gain for the benchmark. 428 right now, closing on 429. Euro dollar at 108. Brent's getting a bit of a lift, up 0.8%. Oil prices higher at $70 a barrel. There's some Iran and Russia sanctions story in the mix there. And gold punching through fresh record highs. A little softer in the session today, but still on track, it seems, as a haven bid to that $3,000 mark. Down 0.2% so far in the session, but at 2,981. Let's get back to the earnings story right now. BMW, the German automaker, of course, which has seen its stock down about 17% in the last 12 months. Coming through with a red head here on the earnings front, BMW sees 2025 auto margin of 5 to 7%. The estimates had been for 6.65%. So at the top end of the range, higher than the estimates, but at the bottom end, below 5 to 7% is the range. The estimates had been for 6.65%. So the estimates not too far wide of the mark when it comes to the outlook for BMW. The Chinese market, of course, really consequential for this automaker as it faces some of the similar challenges to the rest of the industry around a slowdown in Chinese demand. In terms of fourth quarter sales, those numbers came in slightly below the estimates, 36 billion euros. The estimates had been for just over 41 billion euros. In terms of revenue in the fourth quarter, also a little softer. So fourth quarter seems to be a miss for BMW. Again, the margin is the redhead across the terminal with an upside of 7%, estimates of 6.65%. The fourth quarter earnings before interest and tax came in also below the estimates. So fourth quarter, it is a miss for BMW. We have an interview with that company's CEO, Oliver Zipser, which you can see in opening trade at 7:30 a.m. London time. So do stay tuned for that interview. Now, the US Commerce Secretary has accused Europe and Canada of disrespecting Donald Trump. My goodness. Howard Lutnick spoke to Bloomberg's Anne-Marie Hordern after the US president threatened new tariffs on European alcohol.
The president has made it crystal clear that he finds this tit for tat really abusive and aggravating, right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America because that's important. And then, they say, okay, we're going to tax whiskey. And look, I find all this back and forth really off the topic. The key topic is rebalancing American trade. We're going to spend lots of time together, but the president was totally annoyed that the Europeans did this. And so you're going to hear back from someone who emotionally cares about America. He cares about America and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Are you saying this is an emotional response, or will we see 200% tariffs on wine, champagne, and alcoholic products before April 2nd, when the president says is the big one, and we're going to get the reciprocal rollout?
Well, the joy of my job is that Donald Trump makes the decisions, right? And the people around him, we talk to him and we advise him. April 2nd is when we do reciprocal tariffs. And he's called out these products. He wants these countries to respect him. And all this showed you is that Europe and Canada do not respect Donald Trump and do not respect America's ability to build its steel and aluminum industry, which is vital for national security.
OK, the US Commerce Secretary, of course, Howard Lutnick, speaking on Bloomberg Surveillance yesterday. Let's get more of a pulse on these markets and bring in now Viktor Hjort, Global Head of Credit and Equity Derivatives Strategy at BNP Paribas. Viktor, thank you for joining us bright and early around the desk this Friday morning. Let's start with the credit impulse, what the credit markets are telling us about whether or not this is a Trump administration pushing this US economy to a recession.
That's not at all what's in the price at the moment. If you look at high yield spreads, they are widening from essentially 5, almost 10-year lows. If you were to look at these markets and say what kind of recession probabilities are they currently projecting, I would say somewhere between 15 and 20%, which is a very low number historically. So no, markets are not at all pricing in a recession. Correction maybe, but not a recession.
Is there an opportunity to be adding then in credit, given a little bit of the widening that we're seeing, but that lower recession risk? Where are you seeing opportunity within credit at this point?
Yeah, I do think so. First of all, you can obviously have a market correction well short of a recession, given that we're starting with pretty lofty expectations. U.S. earnings expectations at the start of the year were somewhere like 14%. It's slowly coming down to maybe 10% or so.
We're not in capitulation territory yet. Is that your assessment?
We're not in capitulation territory yet, but I think coming off of very lofty expectations for 2025. Now, in order for a correction to sort of come to an end, you probably need to see a bit of capitulation. We are seeing more sort of active trend following type of investors giving up. And that includes a lot of hedge funds, and there's been a lot of focus on that lately. On the other hand, traditional American retail investors are still trying to buy the dip. So maybe some of the confidence there need to be washed out before you have a proper buying opportunity. But I think we're slowly getting there.
What are some of the catalysts that you and the team will be looking for to have the confidence to suggest that things are turning around right now, for the equity markets and the credit markets? What would you need to see in terms of the stars aligning for a more positive outlook?
I think we have actually quite a number of catalysts coming up here over the next days and weeks. Starting next week, Tuesday is a big day in Europe. Germany votes on its debt brake. That's obviously very important for the stimulus situation in Europe. Tuesday as well, NVIDIA has its traditional product conference. That's usually a bullish event for that company, and also given the importance of the tech sector in the sell-off so far. I do think, though, that one of the most bullish things that could happen is actually Donald Trump himself showing a bit of fear and a bit of care about the market correction so far. There's been obviously this assumption that this is a president that cares about the stock market. So far, no signs of that. A little bit more fear, that would certainly help the market assume that there is a Trump put somewhere.
So looking to see if they can revive that Trump put. And so far, he's kind of dismissed, as you say, those market concerns. On Europe, then, you have the prospect, as you say, of additional fiscal stimulus coming through, predominantly from Germany. The flip side to that is that may constrain the ECB. What are those dual impacts on the credit story in Europe?
I think it's mostly a positive one. You are going to get fiscal stimulus, very likely, and that is going to be funded by a lot of Bund supply, but Germany can afford that given where it's coming from. And so you will probably see a steepening, quite sharp steepening of the Bund yield curve. That benefits credit markets in general, typically that combination of stimulus and steeper yield curves. It particularly benefits banks. Banks is probably, let's call it a bit of a safe haven here in a world where there's a lot of tariffs and also an almost pure play on European stimulus at this point.
OK, so bank credit could be a way to play that stimulus story, and that's not fully priced yet.
I don't think so at all. In fact, bank spreads have actually widened over the last couple of weeks or so. But here's a sector that isn't really exposed to tariffs, a sector that clearly benefits from higher long-end bond yields if they were to go up, and a sector that's also, if we're honest, is engaging a bit of self-help with all the M&A and consolidation that's going on in the European sector as well.
OK, so a lot to look for in terms of European credit, potentially as a bit of a haven move within Europe as we look for that stimulus impulse, and maybe some more details next week. Viktor Hjort, thank you very much indeed on these credit and equity markets. The credit markets, from Viktor's perspective, at least the data he's seeing, not signalling a particularly high risk of recession when it comes to the US, at least not at this point. Viktor Hjort, Global Head of Credit, Equity and Derivatives Strategy at BNP Paribas. Thank you very much. Coming up, we're going to speak to the startup helping to protect Ukraine's drone fleets from cyber attacks as we continue to keep a lens on the defence story of Europe and the startups helping to build out those capabilities. That is coming up. This is Bloomberg.
Is really needing to ramp up, get its act together, and show that it can deliver.
So you need to protect your airspace, and it's very visible in Ukraine.
The actual thought that Europe needs to start to get their act together.
The budgets that are under consideration is a plan for the next decade to rearm Europe.
We need to step on the accelerator. More money needs to be available, and it needs to be, especially the procurement needs to work faster.
Need more of everything and of a better performance.
Move at least 10 times faster, and the scale needs to be better in shells, missiles, armored vehicles.
Seize of weapons in Ukraine will not erase the Russian threat.
The whole defense kit that the current industry manufactures is just outrageously too expensive.
There's still a lot of the old red tape around.
It would be a great risk if we stop those investments just for the sake of the ceasefire in Ukraine.
The US are never willing to rely on anyone else than the US, and the US is right. Why Europe should do different?
Defence CEOs and defence tech leaders speaking to Bloomberg through this week about Europe's security push. Now, France is also planning how to finance a boost in its own defence spending and investment. President Macron aiming to raise defence spending above 3% of GDP. Let's get more on the details and bring in Jean Dalbard from Bloomberg Economics. Jean, what exactly is France planning to do to boost defence spending given the budget constraints of that nation?
Sure, absolutely. That's really the big topic currently in France. And actually, we should bear in mind that the military budget comes from 1.3% of GDP in 2013 to 2% of GDP nowadays, so at NATO requirements, and is already expected to increase to 2.5% of GDP over 2030. In this context, the president announced or suggested to increase it further to 3 or 3.5% of GDP. We think 3% of GDP is a much likely scenario, given what you said, the fact that France is lacking some fiscal space. We ran the numbers, and we think it could provide a limited but positive boost to GDP over time, which is something to be considered as well.
And I wonder to what extent that's going to be factored into the decision-making at Fitch. So they're looking to update their credit rating for France later tonight, Jean. How significant could that be? What are you and the team looking for?
So effectively, that's something very important for French credit rating. It comes 2 weeks after S&P's decision to revise to negative the credit outlook for France. Fitch has done the same in October 2024. We do not expect any major surprise from Fitch tonight because we think Fitch will need some time to assess whether France was compliant with its commitment that it has made in October last year, and we would be a bit surprised by any big decision like a rating cut, because basically it needs to wait for the government to deliver. And since October, the budget has been passed, and the political situation has eased a bit, so it is pretty positive for the French credit in that context.
Jean Dalbad from Bloomberg Economics. Excellent context as we look ahead to that Fitch decision, of course, for France. And the defence spending impulse as well, as the French government looks to spend potentially 3% of GDP on defence as it tries to match some of the spending coming through from other European nations. Jean, with the context, thank you. Now, countries are intensifying competition, of course, in the drone industry as well, a crucial part of the defence industry now, and has increasingly become so. We've seen that play out in Ukraine, of course. They continue to play that role in modern warfare for good and for bad. Drones are also opening up a new frontier in terms of cyber warfare, and cybersecurity startup Periphery is helping to protect Ukraine's drone fleets. Very pleased to say I'm joined now by Periphery's co-founder and CEO, Toby Wilmington, formerly at NATO and BAE Systems as well. So with that experience in the cybersecurity space when it comes to the alliance and also, of course, BAE. Toby, thanks for coming in. What exactly does your company do? What is the gap that you are filling when it comes to defence in Europe and specifically right now in Ukraine?
Yeah, so Periphery is a cybersecurity company based in the UK. We make really small software, essentially, that goes into IoT technologies or the Internet of Things technologies. So for the last decade, we've been building security controls for the likes of NATO, as you said, and sort of taking those learnings of securing battlefield systems. We've seen sort of this adoption rapidly take place and come closer to sensitive networks. So looking at what's happening in the Ukraine, they're currently producing over 2 million drones every single year. And all of these things are somehow connected, either directly or indirectly to a network. And we're seeing a real focus now on the IoT industry specifically from threat actors across the world. They're really starting to take an interest and see these things as low-hanging fruit and therefore start to launch attacks against them.
So the cybersecurity risks around those drone fleets, to what extent are the innovations that you're building going to be matched at rapid pace by the innovations of our adversaries? How much of a gap can you build out for Europe and Ukraine?
I mean, the good thing is we've got a lot of strong capabilities here. You know, we have NATO, we've got the US.
For now.
For now.
We've got the US for now.
So we've got a lot of really good security individuals. And I think what we're trying to do, right now we see a lot of electronic warfare happening.
Yeah.
And the reason why we're getting involved is we've seen this interest now, an increase in Q4 last year and Q1 this year in nation states taking interest in the drone manufacturers and actually attacking them as organizations. So what we're trying to do is use our machine learning and our AI essentially to stay on top of and predict the threats that may be coming so that we can isolate those and essentially keep these warfighters safe. But these drones are being used right now on the front lines, but they're also being brought into Europe and the UK in critical infrastructure. So the risks that we see happening in Ukraine are coming closer and closer to us as well.
I'm just thinking it's an arms race within an arms race. I mean, it's hard to imagine. We're not in a direct kinetic conflict with China right now, thankfully, but we are with Russia. It's hard to imagine that Chinese engineers are not going to outpace us in this kind of innovation. I mean, what gives you any level of comfort that we are not going to be taken apart by Chinese engineers at some point?
So I think, if we look at the way AI is being looked at, we look at how cybersecurity is being looked at a government level, it is very encouraging that there's a real focus now. We're starting to wake up a little bit that we can't wait for something to happen, which has typically been the case, and we want to be ahead.
And what lessons have you learned? You are in an active war zone right now, providing your services to Ukraine. What lessons have you learned from that war zone?
So there's not too much that I can share, but I think the difficulty here is someone was talking about this earlier, is the products that are coming from the sort of eastern markets are very, very, very cheap. Okay, and we see the likes of the US putting stipulations in where any technology of theirs can't originate from the likes of China. But obviously, Russia don't necessarily care about that. So we're seeing a big focus in the semiconductor industry to make that cheaper, to make sure that European semiconductors are much more accessible and that devices going into the field are more accessible as well, with security built into it from the get-go.
Do we need to design systems that are not reliant on US hardware and software?
I wouldn't say that necessarily. I think it's too early to kind of say that. The US is very much involved. We've got some of the primes that are obviously US focused, and they're still very much involved in what's going on in the Ukraine. So I wouldn't come to that conclusion.
Are you benefiting from the increase in funding that these governments are pushing through?
I mean, we're donating. everything that we're doing. So for us, this is more of a personal thing for me and for the business. We believe in the sovereignty of Ukraine and what it stands for. And
sure, but you've got to make money. I mean, are you signing contracts with the MOD? What is the growth prospect for the company? Who are you signing deals with? What's the ambition?
Closer to home. We've got to work with the likes of MOD and the primes. We're also doing work with drone manufacturers that are more in critical infrastructure that aren't necessarily in defence. So that's where the majority of our business is, and now we've had the opportunity to be able to do this.
Are the primes, like your former employer at BAE, are they a hindrance, a roadblock, or are they a partner?
I'd say they were slower previously. They are being pushed very much more so by government and the MOD now to really support small to medium business and not to slow us down, but to take the benefits in the fact that we iterate super quick compared to them. OK, let's see if that happens then. Toby Wilmington, thank you very much indeed. Thanks for joining us in the studio. Co-founder and CEO of Periphery, which is a cybersecurity firm focused on the drone space and UAVs, currently in operation in Ukraine. There's plenty more coming up. Stay with us. This is Bloomberg.
Tariffs are bad for growth and bad for inflation, which puts the Fed in a bind. Basically, they're missing by more on both sides of their mandate. So I think in the near term, the Fed's going to basically be on hold, waiting for more information. Trump administration is making the matter worse because not only are they putting tariffs in place that are much larger than they did during the first term, they're doing it in a very haphazard, irregular way, which is creating a lot of uncertainty.
Bloomberg opinion columnist, of course, Bill Dudley, on the impact of Trump's tariffs on markets. And you saw that impact at play yesterday, of course, with the drawdown of 1.4% by the end of the close on the S&P, taking us officially into correction territory. The lowest point in 6 months, $5 trillion wiped off these US equity markets. Then the exceptionalism story around the US crumbling in the face of the Trump tariff threat. But in terms of the relative strength index and whether or not things are looking a little oversold, we are at levels now on the RSI that we have not seen since, you have to take yourself all the way back to 2022, which raises the question as to when this becomes a buying opportunity. Let's flip the board and have a look at what's happening in yields. Of course, the spreads have been tight pretty much over the last, 18 months or so. That story is starting on the very slim edges to erode a little bit in terms of high yield. You've seen the Bloomberg dollar index, the Bloomberg index in terms of high yield. That is down about 1.6% or so in March. So you've seen yields edging higher in terms of higher yield, in terms of the higher yield story on concerns about recession risks, which brings us to the consumer sentiment. The Michigan University Consumer Sentiment Survey out later today. Really important gauge, of course, in terms of the pulse and the health check of the US consumer, as we start to see some metrics, some data suggesting that they are giving up or at least becoming more concerned. At what point is this US going to be talking itself into a recession? Markets currently pricing in about 70 basis points in terms of Fed cuts for this year. We'll see if that adjusts on the back of the data today. At 11 a.m. London time, we're going to be speaking to the NATO Secretary General, by the way, on Bloomberg Surveillance on geopolitics. Up next, though, the opening trade. This is Bloomberg.